Hey everyone, welcome back to Corporate Decoder, the place where we decode the mysteries of the corporate world, one filing at a time. And let me tell you, this latest filing from Carlyle Credit Income Fund is a bit like uncovering a secret recipe, with a few important tweaks. You know, companies like Carlyle Credit Income Fund release these documents to keep us all in the loop about what is happening behind the scenes. Today, we're diving into their latest 8K filing, which is basically like a special report for immediate, important news. Think of it as a company's urgent bulletin, letting everyone know about significant events as they pop up. Now, the big news here is about something called convertible preferred shares. Imagine you have a special kind of stock that can be changed into regular stock later on. That is basically what these are. Carlyle Credit Income Fund has just issued a bunch of these shares, and it seems like they did it to raise some serious cash, about $16.275 million. They plan to use this money to pay back some other preferred shares they had, called series of preferred shares, and whatever's left over will be used for general company stuff. These new preferred shares have a face value or liquidation preference, as they call it, of $1,000 each. This means if the company ever goes belly up, these shareholders get their $1,000 back before common shareholders. They also get a fixed dividend, a nice steady 7.25% per year. It sounds pretty straightforward, right? But it gets a little more interesting. These new shares are pretty high up in the pecking order. They're considered senior to the common shares, meaning they get paid first when it comes to dividends and if the company ever gets broken up. They're also on equal footing with other preferred shares the company might have. However, they do sit behind any debts that are secured by the company's assets. Now, this is a key detail. The company has promised to buy back all of these convertible preferred shares on the 30th of October 2030. This is like a maturity date for the investment. They'll pay back the original $1,000 plus any dividends that haven't been paid out yet. Here is where things can get a bit tricky. The company has to maintain a certain level of assets to cover its debt, specifically an asset coverage ratio of at least 200%. If they dip below this level for too long, they might be forced to redeem some of these preferred shares early. This is a safety net for investors, making sure the company doesn't take on too much risk. The company also has the flexibility to buy back these shares early, starting in May 2026, if they have the money available. They can choose to buy back all of them or just some of them. This gives them options to manage their finances. And here is the convertible part. After 6 months, holders of these preferred shares can choose to swap them for regular common shares. They'll get a certain number of common shares based on the company's share price and the preferred shares value. This can be a great move for investors if the company's common stock price goes up significantly. There is a catch to this conversion though. If converting would cause a specific investment advisor and their associated groups to own more than 4.9% of the company's common stock, they can't convert. This is likely in place to prevent any single entity from gaining too much control through this conversion process. Another important point is what happens if the company gets bought out or there is a significant change in control. In that situation, the holders of these convertible preferred shares have the option to demand that the company buy back their shares at the full price, plus any unpaid dividends. This is another safety feature for these investors. And if for some reason the company's common stock stops being traded on major exchanges for a whole 20 days, the company is forced to redeem these convertible preferred shares. This protects investors from being stuck holding preferred stock in a company whose common stock is no longer actively traded. All of these details about the new convertible preferred shares are laid out in what they call the 5th supplement to their declaration of trust. This is essentially the official rulebook for these specific shares, outlining all their rights and terms. Interestingly, the people who bought these shares, along with a major investment advisor, have given the fund a proxy to vote their shares. This means the fund can vote these convertible preferred shares in line with how all the other preferred shareholders vote. It is a way to streamline voting without requiring each individual holder to participate in every shareholder meeting. This whole sale of shares happened under an exemption from registration requirements. Basically, they are saying they sold these shares directly to a select group of investors, and because of that, they were able to avoid the lengthy and costly process of registering the shares with regulatory bodies. This is common for private placements like this. And to spread the word, on the 31st of October, the fund released a press statement about all of this. Now, looking at this whole deal, Carlyle Credit Income Fund is essentially managing its capital structure. They are bringing in new money by issuing a type of preferred stock that gives them flexibility in the future. The terms are pretty standard for this kind of financing. They've set a clear maturity date, provided protections for investors if the company's financial health falters or if the common stock becomes illiquid, and offered a conversion option that benefits investors if the company does well. The 7.25% dividend is a decent yield But the real story here is the fundraising and the strategic move to manage their existing preferred stock obligations. This move seems designed to shore up their finances and provide capital for operational needs, with the conversion feature adding a potential upside for investors if the company's common stock performs strong. The voting arrangement is a practical step to simplify shareholder engagement. While there are safeguards for the investors, the company retains considerable control over redemptions and conversions as long as they adhere to the agreed upon terms. So, what is my take? Carlyle Credit Income Fund is making a calculated move to rebalance its capital. It is a way to get cash in the door while offering investors a hybrid security that has benefits of both debt and equity. A key risk to watch is their ability to maintain that 200% asset coverage ratio. If they struggle there, it could trigger mandatory redemptions and signal underlying financial weakness. On the flip side, if their common stock performs well, the conversion feature could lead to a significant reduction in their preferred share obligations as investors swap for common stock. It is a classic maneuver to optimize their financing. Alright, that is our breakdown of Carlyle Credit Income Fund's latest filing. What is your take on these numbers and what they signal for the company's future? Do you think this convertible preferred stock offering is a smart move? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord community linked in the description. Thanks for watching. See you next time.